Hello friends, centering my camera so you can see me properly. Welcome to another Stock of the Week. Now I know I get excited about these. A lot of research comes across my desk each week and then my team will filter it. We will look at the data and see what is worth being a Stock of the Week as part of my Dealmaker Diary. Argan, leading provider of engineering, procurement and construction. Not exactly headline making and exciting in the sort of, the breathless excitement of all these newsletters and tip sheets, because we go for data, we go for research, we go for solidity, okay, even if they're unglamorous. The stock has gained a fair bit. That doesn't put us off as long as the fundamentals are there. Okay, the company's focus on low carbon and zero carbon energy solutions positions it well amid the global shift towards sustainable energy. Whatever you think about sustainable energy, the need for it or not, the important thing is demand. I hosted an event last year in the UK Parliament on climate change, and I said, whether you believe in it or not, you've got to think like a business person. Hey, there's a demand, see if we can meet that demand. Okay, so when I look at this company and I look at 23% year-over-year increase in revenues, when I see triple-digit 186% rise in net income, and a market capitalization of over $2 billion, it gets my attention. Now the PE ratio, we're going to come to that and other numbers in a second. They don't necessarily all tick the boxes, but it's the balance overall. Now, as you know, I also like to educate and inform everybody on AI with every company we look at. And the reason I like to do that is because, first of all, look, this is the biggest story of our generation, so we might as well learn. And also because I want to make sure these companies are at the forefront of that. So we've got them using AI for predictive maintenance. Hey, when I think about it, of course they do. That makes sense. In fact, if they hadn't, I'd be worried. Energy demand forecasting. I was at an event today at the London Stock Exchange where technology companies were explaining just how problematic this is. If you can't forecast energy demand accurately, the inefficiency, the costs, and actually the dangers of not being able to supply energy, let alone not being able to supply it at the best possible price, causing cost of living crises. So that's a major issue. Project cost optimization. Again, procurement is the field they're in. You'd expect them to be trying to reduce those costs there. Supply chain optimization, well, you could say that about almost any company, and I'm glad they're also in that. Regulatory compliance, of course, ESG reporting, we're seeing a lot of AI being used there, and workforce and safety management. Again, when you think about it in hindsight, you think, oh, of course they use it for those things. I'm glad they do. I'm less bothered now. This might make me sound like an evil capitalist. Less bothered about safety management in the sense that traditional ways were good. Does this add to the bottom line? Probably hardly makes a difference. I'm talking about bottom line stuff that I'm really interested in for AI. So where are we? Well, on my proprietary value growth income rating, it's a 7. Anything with a 7, 8, 9 or 10, that weighs valuation, growth and income. That's good. The forecasted P, in other words, you're paying $35.9 for every future dollar of profit. That is expensive. There's no way of getting around it, both in terms of its historical P and relative to the economy as a whole and to its industry. Having said all of that, the CROCI, the cash return on capital invested, the number used by Goldman Sachs Wealth Management, which says 30%, the top quartile of companies by CROCI generate 30% per annum as a basket of stocks. That's probably one of the highest numbers, if not the highest I've ever seen. Well, not quite ever seen, but ever seen, and like the other boxes ticked as well. Sortino above 1 is rare for stocks. It means high average return, low downside risk. The volatility is high. That volatility is high partly because it's upside volatility, not downside. So I don't mind that volatility being high. Alpha, the ability to outperform the markets, knocks the ball out of the park, you might say. So if I was going to give the most optimistic, reasonably optimistic projection. That's the one on screen. Now, there's a danger. The danger is up until about 2024, so up until January, February 2024, the company was chugging along. All of a sudden, it has exploded to the upside. Is there a danger it could revert back to a 95, even back to its longer term average price gain? Of course, there's always a danger. There's always a danger of a lot of things. Will it continue at this exponential rate? Of course not. Exponential price movements don't tend to continue. So where are we? Well, I think by putting that reasonable projection, even if that took 2 years, I'd be fine with it. Even if it was half of that in 1 year, i.e. 50% in a year, I'd be fine with it. Okay? So I think we've measured the risk, see the upside, see that you can elongate your time frame or you can reduce your gain projections. Either way, that's one way of mitigating risk and managing expectations, and those are important things as well. So I hope you've liked it. One other thing, discount cash flow, slightly undervalued apparently. It's nice. Tick that box. Nice to have, not essential. Nice to have on a discount cash flow. So there it is. Hope you found it interesting, informative, educational as much as I did. Thank you.